Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I'm really excited to have him back on. His insights on the mining industry are truly incredible. He has a long and successful career as a credit analyst. He's also financed hundreds of mines into development and production. And he's a former vice president at Sprott Inc. He's one of the larger shareholders of the dividend-paying Sprott Inc. that creates all these wonderful mining stock ETFs and metals trusts for gold, silver, platinum, palladium, and uranium. Rick Roll, thank you for joining me again.
Jason, a pleasure. Thank you for having me back.
So, Rick, we're recording this interview on Friday, May 24th, 2024. The gold price has corrected a little bit. It's down to a little bit above 2,300 at $2,333. Silver price has retreated, still a little bit above $30. I want to get your thoughts, though, on the profit margins for the gold and silver miners, especially gold, silver, and copper miners for Q2. Now, the gold price spiked, I think, in March. And for the Q2 earnings, this is going to be the first quarter of 2,300 gold for the whole quarter. Do you expect record profit margins for a lot of these gold, silver, and copper miners, or do you think the industry is still going to struggle with maintaining profit margins to grow free cash flow?
I think we saw a 90-day period of enough escalation in the gold price that it probably, the increase in the gold price probably allowed the producers to at least amortize the increase in input costs. But it's important for your audience to understand that over the 3-year time frame, as an example, where the gold price has gone from $1,800 to $2,300, that not all of that money reported to margin. Wages have increased substantially, energy prices have doubled, steel prices and cement prices have increased. And remember, in a capital-intensive business like mining, a doubling of the nominal interest rate does a truly ugly thing to margin. So the fact that the gold prices have increased by $500 an ounce does not mean that the industry margin has increased by $500 an ounce. That's very important to understand, and I'm glad you brought it up.
So people then are there's going to be surprises then for the earnings, but they're not going to be pleasant surprises. And it's going to be like a lump of coal in people's stockings, or someone's going to check on the bottom of their shoe and there's going to be doo-doo on the bottom of the shoe.
I think what you're going to see, which one would expect, is that the industry results are going to be mixed. You are going to have some companies that have been able to very efficiently utilize the increase in the gold price. There are going to be other companies, particularly ones who are in areas that have been impacted by dramatic wage increases, that aren't going to see the type of increase in free cash flow. The other thing, Jason, that investors really need to pay attention to is that the social expense with regards to mining is skyrocketing. The amount of requirement for non-mine site expenditure by mining companies is increasing. The royalties are increasing. The taxes are increasing. The payroll taxes are increasing. I was told by a major mining company executive who asked not to be named that his social expenses around the world are increasing at 25% compounded. When you think about expenses on an operating gold mine, the things you think about are like steel for balls or grinding balls, or diesel or gasoline or electricity or labor. But particularly in emerging and frontier markets, the increases in social expenditure are an increasingly difficult cost to contain.
Do you mean like infrastructure where like the miner announces on their website or investors' presentations that they're building like power lines and schools and roads and clean water and stuff like that around the mine in the neighboring town, or is it something else?
We've always had to do that in the mining industry. But as an example, in countries like Mali, the expectation of the royalty to the central government goes from 2% to 7%. That's a tripling. At the same time, the expectation is, and I'm singling Mali out because I've been reading about it, but use Mali as a sort of a euphemism for frontier markets around the world. there is an expectation that the state be awarded a free carry, which is to say a working interest in the mine that doesn't carry any responsibility for capital cost. Think, too, that the mining industry is increasingly being asked to form social trusts so that in addition to paying royalty, in addition to paying tax, that the governments are trying to offset some of their local and regional expenses on the mining companies.
Okay, so they're cannibalizing the equity of the mine and a lot of the value of the mine. They're doing it slowly, but it is increasing, is what you're saying.
Exactly right. Exactly right.
So then some of the good earnings that we had in Q1 from like Agnico Eagle, Alamos Gold, Kinross, you think that Lundin Gold, those are going to be kind of the star performers while the rest of the industry may continue to struggle, like some of the stuff we saw with New Gold, how they had to buy a stream back for the Ontario Teachers Pension Fund, that you think that there's going to be continued cost control pressure. Is it going to be similar to 2011? What happened there? Because for listeners out there, we had a big metal spike from 2010 to 2011, big run up in the gold price. It crashed. It went from sub $1,000 or around $1,000 up to 1,900 in under 18 months. But if I remember correctly, you and other people were warning that the mining costs, all the costs for a lot of the miners, whether it was truck tires, employees, labor, all these other costs were rising faster than the metals prices back then.
Yeah, it's easier to look at that whole decade, Jason. Look at the period 2000, and we'll cheat a little bit, 2000 to 2011. The gold price increased from, if my memory serves me correctly, something like $250 an ounce to a high of $1,900 an ounce. And amazingly, the free cash flow per share on the XAU declined. We had a sevenfold increase in the selling price of the product, and the free cash flow declined. Now, how did that happen? Three things. The finance industry asked the gold mining industry to grow. And so there were capital decisions around mergers and acquisitions. Remember Kinross buying Redback for $7 billion. In addition to that, there were ill-considered production decisions made. And on top of that, of course, the operating costs increased. Things like large truck tires going from $3,000 a copy to $18,000 a copy. So you had a triple whammy. But I have to believe in that decade that most of the mining industry's ills were self-inflicted. I'm much more confident this cycle. The institutional investors are keeping the miners on a much tighter leash than they did in the 2000-2010 period. Indeed, the management teams that presided over those bad investment decisions were virtually in every case thanked and excused, allowed to do something else for a living. And I suspect that those lessons have, at least for the next 2 or 3 years, been learned. And then you have companies too, both Agnico Eagle and Lundin came to mind, who did so much social work before the mine was built that they have less ongoing regional sociological expense. Lundin doesn't have to build schools in eastern Ecuador now because they already did that. You follow what I'm saying?
Yeah.
They have already expensed large amounts with regards to social license. So one would expect, while their costs will escalate, that the type of effort that most companies have to do after production has, with certain companies, already been incurred. It's something that requires due diligence that you don't necessarily see on an income statement or a balance sheet, except where you see abnormally high non-capitalized expenses, which is to say pre-mine capital expenditures that rather than being amortized over the mine life are in fact expensed, which most social expenses are. It's very, very, very difficult to see it before it occurs. But it's wonderful in the case of Lundin Mining as an example to enjoy it after it's occurred.
Well, Lundin Mining and Agnico Eagle, the two ones you named, also have premier assets. I mean, they have some of the top high-grade, low-cost gold mining assets on the planet. I would say Agnico Eagle probably has 2 out of the 5, and Lundin has 1 out of the 5. I mean, Fruta del Norte is a premier asset now in terms of cost, grade, exploration upside. So they have a lot more profit margin and free cash flow, and I think they just keep finding higher grade gold on their exploration drilling.
Yeah, I think that's accurate. The other thing that you have to understand is that the Lundin companies have been pioneers in regional social expenditure, intelligent regional social expenditure, going back 20 years. And that's paid dividends. There are other people who have tried to operate in Ecuador and have run into localized sociological challenges that they have been less effective in dealing with. That sort of thing is really, truly built into the Lundin family DNA. And while I absolutely agree with you that the 10 gram, 11 gram nature of that deposit makes it sort of a superstar. It's both large and high grade. What people understand less well about the Lundins is the fact that in terms of their local and regional sociological work, that they've done a superb job. By the way, as long as we're talking about Fruta del Norte, I was very skeptical when the mine was being built. I was a large shareholder in the discoverer of that mine. I benefited mightily when Kinross took the mine over. I was very nervous about the Lundin family's ability to build that mine on time, on budget. It ended up the Gignac family, now G Mining, did an absolutely superb job of mine construction. I was concerned also because this was sort of a polyphase deposit, which meant that the Lundins had to mine different types of ore from the same mine and process different types of ore through a facility, which required a sequencing sophistication that I wasn't sure that they could pull off. On top of that, inside the mine, or at least inside the ore body, there were some really difficult ground conditions. And I think the Lundin team, and for that matter, the Gignac construction team, deserves special credit for the fact that what was a large and high grade, but extraordinarily problematic ore body came in on time, on budget, and more efficient than nameplate capacity. I mean, that was a really a superstar achievement.
And the mine was initially found by superstar geologist Keith Barron, who's had a lot of large discoveries in his career.
He's a true piece of work. You should interview him sometime if you haven't done so. He's a sort of an Indiana Jones type guy. Really, really, really fun. As an example, he has prospected in the Vatican archives, looking for historic evidence from the church around gold occurrences in Ecuador and Peru that the church sent missionaries to in the 1500s and 1600s, looking for deposits that were substantial enough that they were mined at that period of time and may have been forgotten. I mean, this is a unique human.
That's a very interesting story that you just gave. Now, in terms of financing, how the mining industry has changed, do you think that mining stock ETFs, now you said that a lot of mine financiers like yourself, banks, pension funds, they're not as aggressive about giving out capital to miners for developing and building mines. Do you think that mining stock ETFs have diverted a lot of capital away as well? Because the miners not directly getting capital raises, right? Even if they're in the ETF, a large portion of it.
I don't think so, actually. I think that veteran mine investors like myself got sick of the misapplication of capital. There's a lot of money around, and a lot of us that were 30 years ago financing mine construction have in the last 10 years diverted increasing amounts of extractive money into businesses like oil and gas. I will tell you, too, that at least for companies that are dual listed, Canada and the United States, that can access U.S. capital markets, that the money that flows into the ETF can indeed go into equity placements by the company by way of these at-the-market financings, where the companies have evergreen prospectuses, and the company's market makers can capture part of the volume that occurs in the stock on a daily basis. The company creates new shares, which the market makers basically buy to cover short positions that they establish day by day. So, in fact, we have a very efficient mechanism in the U.S. for monetizing aftermarket volumes in these companies and putting that money into the market. And the ETFs, in terms of companies of a certain size, normally north of $1 billion in market cap, and normally, but not always, New York Stock Exchange listed, have more effective fundraising mechanisms through the ATM than they formerly had through the dealer network.
Now, I know you've said publicly that you also like buying dividend stocks. You're a shareholder in Sprott Inc., which is does not do any mining, and they have a lot of different diversified commodities exposure with the commodities ETF trust, mining stock ETFs, and they pay a dividend. Do you expect some of these gold miners to start increasing dividends, or do you think most of the dividend increases for at least the next couple quarters, if gold prices stay around these levels, are they just going to be solely from the royalty companies like a Royal Gold increasing dividends by 7% over the last year, or Osisko Gold Royalty announcing an 8% dividend increase in the last quarter?
I think that you are going to see, I think it's going to be spotty. I think Agnico will increase their dividend because they're generating a lot of cash. I think Barrick might be dividend challenged because they're going to build a $7 or $8 billion copper mine in Pakistan. In other words, they have uses of the money. I think it's going to be spotty. The Newmont dividend is already reasonable. I think coming down the market cap range, it's going to be interesting. I believe that Lundin could easily pay a generous dividend now that they have paid off all of the capital costs, including the hybrid capital cost around Fruta del Norte. But there's a lot of speculation in the market that Lundin is considering a transaction. It may be an all-share transaction. I'm not trying to say it'll be a cash transaction. But even if it were an all-share transaction, one would expect that whatever they acquire would likely be a development stage asset, which would require the application of their own free cash flow to mine development. And by the way, I'm not giving you inside information. That's just a market rumor.
Yeah, I mean, there's been a bunch of different rumors with Greenstone, which just poured first gold. I mean, there were rumors that some of the larger miners like Bear Gold and Newmont would try to get their foot in the door with a 40% stake that Orion Mine Finance just sold. And they didn't seem really serious about the bidding. And then Equinox Gold, I guess it's good long-term for Equinox Gold shareholders. I mean, it adds more risk. I guess it's high risk, high reward now with what they've done with their balance sheet by adding 100% of Greenstone.
The balance sheet was already challenged around Greenstone. So that team has made an all-in bet. That team, having achieved on time, although not on budget capacity, now needs to spend 6 or 9 months reaching nameplate capacity, meaning that now that the mill has been turned on, now that the mine has been turned on, they need to bring it up to steady state production, the type of steady state production that was envisioned in the feasibility study. That normally takes between 6 and 9 months, sometimes longer. That team and their adult supervision, as I call it, Ross Beatty, are extremely confident that they have built an absolute Cadillac mine. And they believe that the ore body as mined will reconcile higher in terms of both grade and grade continuity than was envisioned in the feasibility study. If they're right, they got a very good deal from Orion. I think it'll take us, Jason, probably 3 quarters to determine that. As we discussed before our call, I never personally considered Newmont or Barrick to be competitors for that asset. Although I think that ultimately in the mine life, that mine may produce 5 million ounces, which is the announced cutoff for both Barrick and Newmont. The measured and indicated reserves and resources that exist today don't approach that. And neither company has expressed very much interest in acquiring a minority interest in a mine. That is to say, being 40% owners rather than 60% owners, and not the operators of the mine, is contrary to the corporate philosophy of both Barrick and Newmont. Probably the natural acquirers would have been people like Kinross or Agnico. But again, in both cases, Kinross and Agnico like to be majority partners and operators rather than minority partners and non-operators.
Well,
So
Kinross
I think the
is
asset went to the right place.
isn't Kinross going to have to spend a lot of capex in the next, I don't know, 3 to 5 years trying to build out Great Bear, though?
They absolutely positively are. And I'm delighted that they've chosen to focus on one thing at a time. That, that's going to be an interesting build. It's an interesting build too, because they signaled to the market that when they bought it, that it had substantial exploration upside. So I think in the case of Kinross, that you are going to see them attempt to prosecute the exploration upside in conjunction with pre-mine development. So as you point out, uh, they're going to have a lot on their plate, both intellectually and financially.
Most of the Greenstone land package, it hasn't been drilled though, right? So there could be additional discoveries there. I think they found an underground mine, and that's going to be added into the mine plan over the next couple of years after the mine gets up to the nameplate production capacity and free cash flow. So there is still a lot of upside at the mine, even though the measured and indicated, like you said, is low.
I think there's a certainty that that ledge repeats. That hasn't been demonstrated yet, but I believe that that mine ultimately, or that district, pardon me, becomes a multi-decade producer. You can't ascribe value to it today, Jason. I mean, you have to have some pierce points, you have to have some data. But I think the nature of that mineralization and the nature of the belt that it's hosted in means that it's inevitable that parallel sequences occur and that sequence extends to depth.
So if I was to summarize your views on the gold companies for companies that could potentially grow dividends, you do not think that the majority of gold miners will be able to consistently grow their dividends. Then people should be looking at the royalty companies, the larger, the senior one, medium-sized ones, and then companies like Sprott Inc.
Well, you have a conflict with me with Sprott Inc. I'm the largest shareholder of Sprott Inc. Um, and I'm not sure that I can take that hat off. In Sprott Inc., you don't have capital expenditures. I mean, maybe you have some advertising expenditures to the extent that precious metals prices, or by now, with their nickel products, copper products, and particularly uranium products, to the extent that people believe in an actual bull market in resources occurs. What you see at Sprott is that their exchange traded products, be they the physical metals trusts or the ETFs, will be able to expand assets under management organically without any expenditure. When assets under management increase, management fees increase, and the amount of extra general and administrative expense relative to that are needed in order to enjoy those increases in management fees are minimal. So you go from at once having an increase in revenue and simultaneously you enjoy a decrease in the percentage of that revenue that has to be allocated to general and administrative expense. In a capital light environment, which is to say where you don't need to build very large working capital reserves because you don't use capital for anything, a whole bunch of that surplus gets to be distributed to shareholders, which is something that I, as a large shareholder, am looking forward to. If you believe in the bull market in precious metals and industrial materials, which I do, it's almost inevitable that the dividend at Sprott, which is fairly conservative given the free cash flow growth that they've enjoyed in the last 18 months, continues. I think that the senior royalty and streaming companies have the ability to increase their dividends. I'm almost unique in the view that their ability to deploy capital in the next 5 years will be much higher than it's been for 10 or 15 years. I believe that as a consequence of the industry's need to build more very large copper mines, that the copper industry will finance some of the equity portion of the enormous expenditures necessary to put a porphyry copper mine into production by selling streams on the byproduct gold and silver from these copper mines. And I think that the opportunity available to the large royalty and streaming companies in the next 5 years is one that's measured in the multiple billions of dollars.
Yeah, I agree. There's a lot of opportunity there. I think it's the demand growth for copper, and I think a lot of this, and I just started researching this over the last 6 months, and now you're starting to see all these mainstream articles come out about it. It's all these next generation technologies. It's the data centers for artificial intelligence. It's the amount of electricity required. It's the constant replacement of semiconductors and microprocessors. I think the average person out there thinks that if they use ChatGPT on their phone for search, that it's not that much different, the back end of it and the electricity usage compared to like a Google search. The electricity usage, Rick, it's 10 times the amount of electricity usage per search.
Agreed. That's on the demand side. What people who aren't from the industry seem to forget is that we have been underinvesting in the copper business on the supply side for 30 years. And that's coming home to roost. The pipelines for production that we have in the copper business are extremely constrained, and the copper deposits that are available to put into production are mostly fairly large but low-grade porphyries that have very, very, very large capital expenditures associated with them, even for a company like Freeport-McMoRan or Rio Tinto or Barrick.
So
The idea that you're going to be building mines sort of $8 billion a clip means that the upfront capital expenditures are going to be excessive. And it's very likely that part of those enormous upfront expenditures are going to be financed, even by the largest mining companies in the world, by selling streams on byproduct gold and silver production.
Yeah, I agree. So I was actually going to ask you when you said what you meant by very large. So you said $8 billion. I think the average person thinks that when the copper price spikes, that new supply can come online quickly. And it takes in many different countries over a decade of drilling, discovery, permitting, feasibility studies, getting financing from people like you or banks or institutional investors. And then you have to build the mine on time and on budget. I mean, for a large scale copper mine, it's billions of dollars and over a decade in many countries, right?
Here's an anecdote for your listeners, Jason. The best undeveloped copper deposit in the United States is called Resolution. It's in a wonderful part of Arizona, surrounded by copper mines, so skilled labor, power, water, roads, rail, everything right there. The deposit is at last reading about 2 billion tons of 1.5% copper, 3 times the average mine grade worldwide. That mine has thus far been 25 years in permitting with no end in sight.
What? Who's blocking the permitting if all the copper mines are already right there?
Everybody wants a piece of the pie. Everybody wants a piece of the pie. The other big copper development story in Arizona, of course, is Rosemont, which has run into problems with the Apache Nation. The Rosemont deposit allegedly underlies terrain that the Apaches considered sacred. I don't know if that's true or not, but all I'm trying to say is that there are a variety of stakeholders who, while some of their concerns are legitimate, constrain the industry's ability to deliver increases in copper supply. These, in some countries, will be overcome. Chile, as an example, the permitting regime is fairly straightforward. It's long, it's cumbersome, but the rule of law applies. We understand how to do it. What's going wrong in Chile has been that the escalation in social costs, the costs of the cash flow that's expropriated by society in Chile has tripled in 10 years. that's a different challenge. That reduces net present value when you give more than half of it away to the state. So, there are going to be ongoing challenges around copper. We'll overcome these challenges because copper's utility to society is so high that the price of copper can and will go up to accommodate these challenges. But the fact remains that, as you suggest, even if the copper price were to go up another buck a pound or $2 a pound, in the near term, it wouldn't impact supply very much because the process by which you permit a mine and you finance a mine and you build a mine, very, very, very long term. I've been involved in a copper deposit on the coast of Chile in an inappropriately named company called Hot Chile. We've been working on the exploration side of that deposit for 15 years. It's become a very, very, very large deposit. We still haven't drilled it off completely, and we aren't even in the pre-feasibility stage. So if you think about the fact that exploring for and delineating a tier one deposit commonly takes 15 years. And then you are somewhere between 5 and 10 years in pre-construction, which is to say permitting, financing. Then you're 2 or 3 years in construction. Then you're 9 months to 12 months in shake-in, which is to say going from on time, on budget to nameplate capacity. It commonly takes 20 years from discovery to production for a tier one deposit. Those are some of the challenges in front of us. There are probably now, at today's copper prices, at today's interest rates, there are probably 15 or 20 undeveloped copper deposits in the world that would work in today's economic circumstances. With today's interest rates, if interest rates go up, of course, that shakes some of them out. If social costs go up too much, that shakes some of them out. But you know what I'm trying to say. All things being equal, at today's copper prices, today's energy prices, today's social rents, today's interest rates, there are probably 15 decent-sized copper deposits in the world that can be brought on. But they won't be able to be brought on in time to deal with the supply shortages, which we're certain to face in the next 5 years.
Yeah, I agree. I think we see a huge supply and demand imbalance if people like Mark Zuckerberg, what he said on a recent podcast about how they basically want to build these data centers for the next generation of technologies that are an order of magnitude larger or close to an order of magnitude larger. And then you have Microsoft and OpenAI Systems, the company that came up with ChatGPT. They want to build the world's largest 5 gigawatt, $100 billion data center by 2030. So, I mean, if so it's just talk now. I don't think they've started on construction on some of these data centers. There's a lot of them here in Northern Virginia, right outside of Washington, D.C. Those are kind of like some of the newer ones, but those are not the next generation. The next generation ones, according to the Washington Post, Rick, in February, they said we need another 2 nuclear power plants built here in the area to deal with the data center growth.
Well, certainly both Elon Musk and Bill Gates have talked about that extensively. Let's assume just for a second, Jason, I'm not discounting it. Let's assume that that doesn't occur at all. There are 1 billion people on Earth that have no access to primary electricity. There are another 2 billion people on Earth that have access to only intermittent or unaffordable electricity. One of the unsung successes of the human race in the last 40 years is that we've lifted 1.5 billion people around the world from abject poverty to making them just poor. We believe that the job of electrification to the marginally supplied and the unsupplied will be accomplished over the next 20 or 25 years. Getting them the electricity requires enormous amounts of copper. Building out generative capacity for them requires enormous amounts of copper. And once you get the copper to them, their ability to utilize it in a vehicle, in a house, requires enormous amounts of copper. Even if what you describe doesn't occur, by the way, I believe it will occur, but even if it doesn't occur, the job that we have as a species, improving the material living standards of the bottom third of humankind, require copper production that likely doubles by 2050.
what is the ore grades going to look like? Because I mean, I take a look at some of these companies. I look at Pan American Silver. I went back to their 2013 annual report and looked up their average silver grades. It was almost 400 grams per ton average silver grades back in 2013. And today, their average ore grades are below 200 grams per ton of what they're producing. Now, obviously, they have La Navidad and the other one in Guatemala that can restart. But is this like the new normal where ore grades for copper, gold, and silver, they're going to repeatedly continue to fall like clockwork every 5 to 7 years?
I mean, with current technology, yes. If technologies like Robert Friedland's Typhoon technology, which is to say better ground penetrating radar, better geophysical technology, allows the mining industry to achieve some measure of the exploration efficiency that the oil and gas industry has achieved, then probably we deal with that. The human eye can see about an angstrom into the earth, and most of the high grade ore deposits in the world haven't been discovered simply because they haven't been seen. So, to the extent that technology like Typhoon is perfected, then, and by the way, you'll notice, Jason, I said if, not when. If it improves, then grade improves. If it doesn't improve, grade's in terminal decline. 15 years ago, the median mined grade for copper production worldwide was 1.5%. Now it's a little less than 0.5%. That's a pretty egregious grade deterioration.
So for listeners out there, 0.5%, that means that the mining company is moving a ton of rock or 2,000 pounds of worthless rock to get less than 1% of copper per ton.
Yeah. 1% copper for a short ton. For a 2,000 pound ton. In other words, 1% is what, 20 pounds? 20 pounds of copper at $4.50 a pound, $90. 0.5%, that's pretty ugly. There's 10 payable pounds of copper in there for moving a ton of rock. You have to move a lot of tons, and you have to mine it, and you have to process it extremely efficiently to make money at those grades.
And the gold deposits, the grades probably over the next decade or so, maybe even faster than a decade, the gold grades, we could go to below 1 gram per ton average grades, especially with these larger open pit grades with a lot of copper there and open pit copper and gold deposits. And in silver, I mean, the silver grades have fallen, I think, faster than any of the other metals, because I remember when I started this back in 2008 financial crisis, there was a lot of mining companies with 300, 400, 500 an ounce gram per ton deposits. I mean, today that's like a world-class mine.
Yeah, I think what you say is true. It's important not to conflate grade too much with with silver supply. Remember that only 17% of primary silver supply comes from silver mines. The rest comes as a byproduct. And there are mines, as an example, copper mines or zinc mines, where silver is such a byproduct that you could say that the silver's free. In fact, it reports financially as a credit against the zinc cost or the copper cost. But what you say with regards to primary silver mines is true. And the deposits in the silver business that we're finding that have requisite grades often occur over widths in the veins that aren't mineable. Remember that in an underground mine, mostly the mineable widths are something like 1.75 meters, 1.6 meters. And if the vein that you're finding, that you're seeing on a press release, as an example, is 400 grams over half a meter, what happens is that you're having to move over a meter of rock to get at that half a meter of good rock. That means, in effect, that the grade that you're mining isn't 400 grams. It's more like 150 grams because, you're spreading it over all this waste wall rock.
So I want to transition now to platinum group metals. Recently, the acquisition or the rumors, there's been, I think, 3 bids now for BHP Billiton and Anglo American. And one of the major parts of the transaction is that BHP Billiton want Anglo American to either spin off or sell the platinum and palladium mines. But do you think, as a contrarian, I know you're a big distressed asset contrarian value investor, do you think that people should be looking at the ratio for gold to platinum right now being historically low, that the market's basically pricing in that a lot of these platinum and palladium miners in South Africa and Zimbabwe are going bankrupt? But do you think that we're still going to have demand for platinum and palladium in years from now?
I absolutely positively do. Platinum and palladium prices are constrained for two reasons. The first, like 1990, is that the world's second largest producer is Russia, and they need money. And when the Russians need money, they empty the cupboards of all of their inventories, including nickel, potash, and platinum and palladium. We saw that in 1990, 1991. The selling pressure abated when the Russians ran out of material to sell. I don't know when that occurs. The second thing around platinum and palladium in terms of speculative appeal has been that the primary industrial use for platinum and palladium is as an autocatalyst in internal combustion engines. The popular narrative, Biden's narrative, Greta Thunberg's narrative, is that the internal combustion engine goes the way of the dodo in 2030. But that's not going to happen. Demand for platinum and palladium as autocatalysts is going to continue, from my point of view, till at least 2060, 2065. So I'm attracted to platinum and palladium. I am concerned about South Africa. I've been investing there really since the end of the 1970s. And you have a political and social situation in South Africa where the signals from the ANC and the EFF are such that the mining industry doesn't know how long they will be able to maintain control of the mines, whether they'll be overtly nationalized or covertly nationalized through taxation and what I would call other forms of theft. The consequence of that is that the major platinum mining companies, including Sibanye-Stillwater and, of course, Anglo-Platts, are reticent to make the large capital expenditures in the mines that need to be made. They're substituting, in effect, labor for capital. The labor that doesn't employ capital, underskilled labor that isn't employing capital, is very inefficient, which means that the amount of money that the industry can pay the labor force is insufficient to sustain the labor force. The workers' wages have to go up, but they can't go up, which is a real problem. It's a real severe problem. Meanwhile, there is, partially because of this artificial substandard wage level, real sociological challenge in the Platte Reef. And so despite the fact that I am virtually certain that the platinum and palladium price goes up, I have a difficult time playing it. Because I'm an American citizen, I can't own Norilsk, the Russian company. And I think the fiscal outlook in Russia is challenged because of the Russian government's need for money. Because of the political and sociological challenges on the ground, in South Africa, I'm leery about owning South African platinum companies too. From a production viewpoint, that leaves Zimbabwe, which is frankly in worse shape than South Africa. So what I've tried to do is I've tried to look for development stage platinum and palladium assets that have the potential to be world-class, that are anywhere in the world outside South Africa, Zimbabwe, and Russia. But that's a real skinny list.
Well, you also have the Sprott Physical Platinum and Palladium Trust. I think that was created in the last couple of years. So, but you're not getting any operational leverage or free cash flow or dividends. That's not going to do any of those things. So that will give you platinum and palladium exposure. It will not give you any operational leverage or dividend potential, though.
And I am, in fact, an owner of that product. And, of course, an owner of Sprott Inc., which benefits indirectly from the management fees associated with that product.
Now, you said Russia's flooding the market with platinum and palladium, but I thought the London Metals Exchange just put sanctions on them, saying they're not going to buy Russian metal. Are you saying that Russia is like selling the metal like black market to, like, I don't know, China or India or whoever else needs it then?
Exactly. Sanctions are the ultimate stupidity. We put sanctions on the Russians, and so the Russians sell to the Saudis, to the Iranians, to the Chinese, to the Indians. And the material that used to go to those markets comes back through London into the United States. It's all political theater. I'm tempted to use that old-fashioned political and economic buzzword. It's bullshit.
I mean, when the US put sanctions on Russian oil, right? I mean, like India was buying it at a discount. So, I mean, there was still people, Japan, I think, asked for a waiver. So there was people still wanting to buy their oil.
And, now we've sanctioned the Russian uranium, and the Russians now are going to say, well, because you won't buy it from us, we won't sell it to you. Well, guess what? That uranium's going to find a home in a nanosecond. It's going to go to China. It's going to go to Japan. It's going to go to Korea. It's going to go to India. It's going to go to the United Arab Emirates. And the material, largely Australian and Chinese material, Kazakhstani material, Canadian material, that used to service those markets will come to the United States market. It's all political theater.
I actually wanted to ask you about uranium. I want to ask about near-term production growth. So Cameco and Kazatomprom are having some problems growing production. Cameco hedged some of their production. These other smaller uranium producers, I know you like them in the past, like Uranium Energy Corp and Uraners. They do some type of uranium mining called what's in situ. It's not normal hard rock mining. Can they be online and producing uranium, I don't know, 6 months, 12 months from now, efficiently compared to a normal large-scale uranium mining operation?
I think 12 to 18 months, the answer to that is yes. It's worthy to note that although in situ recovery uranium mining in the United States will make a difference to the share prices of uranium producers, it'll do almost nothing to the global supply of uranium. The uranium in the United States that is slated for near-term production, 4 mines, will probably in 2026 contribute about 4 million pounds a year, which is to say sort of a burp in a windstorm. The ability of the Kazakhs to return some of their in situ projects, in particular Inkai, to production, has the potential probably to yield another 15 million pounds. That's somewhat more substantial. They have experienced difficulties in that ramp up, however. They have also experienced, and I'm not sure the reason for this, an extraordinary turnover in their middle management ranks. And one wonders if the turnover in the middle management ranks is one of the things that's hampering their ability to return those assets to production. It's important, Jason, for people studying the uranium market in terms of potential restarts to remember that both Cameco and Kazatomprom mothballed about 40 million pounds of annual production. And they said to shareholders that they wouldn't return that material to the market. They wouldn't resume production until they had been able to contract out over sufficient terms, sufficient volume, that their shareholders could enjoy reasonable returns on capital employed. If you take them at their word, what you're going to have to see in Cameco is a couple of their existing contracts, which are fairly low priced, roll off. And then you're going to have to see enough of a contract cycle take place that the market, not in the spot sense, but rather in the term sense, can accommodate a major portion of the 40 million pounds a year that they propose to return to production. There are other resources in Kazakhstan that are greenfield, or rather brownfield sites, that could aid supply, but they won't be aiding supply for 5 or 6 years. Similarly, the wonderful discoveries made by NextGen and Fission in the western flank of the Athabasca Basin, while they will make a substantial difference in world production 10 years from now or so, will require at least 10 years to be permitted, financed, and built. In the near term, we have some real challenges. There is, as you suggest, a reasonable amount, probably 8 million pounds a year of supply in the U.S. if every mothballed U.S. plant in Texas and Wyoming were returned to production. It wouldn't make a difference in a global sense, but it certainly would make sense in terms of the share prices of U.S. producers, in particular because over the last 5 years, the administration has gone, the executive part of U.S. government has gone from being solidly anti-nuclear to deciding to ironically subsidize the domestic uranium business.
I was actually going to ask you if the tide is starting to turn with policy, Democrats, Republicans, Congress, a lot of the Department of Energy officials, that they're starting to turn to being pro-nuclear again.
Even the co-founder of Greenpeace is pro-nuclear. Jason, I've never seen this kind of turnaround in my life. It's sort of embarrassing for me, actually, when I consider who those people are. Part of me would prefer to have them as enemies as opposed to friends. I feel cleaner that way.
Well, I think during the pandemic, people got exposed to increases in their bills of $1,000 a month in Europe. So United Kingdom, Germany, other parts of European Union for electricity bill increases. You're a small business owner or you're not super well off, super rich or affluent. And then all of a sudden you get hit with another $1,000 a month electricity bill. So, I mean, like people are going to start to say, well, I want cheap electricity. I can't have my electronics, run my business, do normal everyday things at my home without cheap electricity. So people took it for granted. They thought, oh, I could have wind and solar. You cannot have reliable, cheap electricity baseload. And then also you can't have you can have one or the other, either an electric bill that goes up like that and unreliable with wind and solar, or you can have cheap electricity. You can't have both.
We have to unpack a couple things. Remember that wind, solar, and nuclear generate carbon-free electricity. And there seems to be a social and political consensus around the fact that carbon-free electricity is important. As you point out, wind and solar are intermittent. Nuclear is baseload power. Another thing that we have to consider, and I think voters are starting to understand this now, in the 45 years that I have been involved in natural resource investing, we have invested well over $5 trillion on alternative energies. And that $5 trillion investment has decreased the market share of fossil fuels from 83% all the way down to 82%. The idea that we could, overproduce wind and solar to account for its intermittency, or that we could make up for the deficit with batteries, is statistically impossible. We're $5 trillion plus into a generative spend, and we've reduced the market share of fossil fuels from 83% to 82%. This isn't narrative, okay?
Math.
This is arithmetic. It's real simple stuff. And if we're going to have affordable baseline power, never mind for data centers, for the billion people on Earth that don't have access to primary electricity, there's only one answer. That's nuclear.
And like you said, the $5 trillion, I mean, if a solar, wind, electric vehicle company, if that company needs a bailout or that company goes bankrupt, I consider the return on investment for the taxpayer when the government's allocating that capital towards energy, I consider the return on investment zero or negative. But the people here in Washington, D.C., the D.C. metro area, they don't consider that at all. They're ignoring all the realities of all these electric vehicle companies, electric bus companies, solar wind companies that went bankrupt or need bailouts. They're ignoring that, and they're talking about we need to spend even more on the energy spending grift going forward.
Absolutely, and I'm personally not in objection to all forms of wind and solar. I've invested in both. Solar in Calexico, California, on the roof of a Costco, where it's used to generate power during the summer when the air conditioning costs are high, makes absolute sense. Solar and wind off the grid in Chile, where there's plenty of wind and plenty of sun, and you need auxiliary electricity to run a copper mine, makes absolute sense. Solar in northern Germany, where the sun doesn't shine, is really problematic. I mean, I laugh, but it's really problematic. It's problematic in particular because the policymakers get so caught up in the narrative that they forget the arithmetic. Let's assume it was a little more efficient. Let's assume somehow that there were advances in battery technology that dealt with the fringe problems of intermittency. The truth is that we spent over $5 trillion reducing the market share of fossil fuels from 83% to 82%. Meanwhile, we still have 1 billion people on Earth who over the next 20 years will be consuming electricity who don't now, and another 2 billion people on Earth that are burdened by either unaffordable or intermittent electricity. And then on top of that, we have societies like China who admit that airborne particulates, mostly from coal burning, kill 500,000 people a year. I'm not suggesting, by the way, that coal demand won't increase. It will, because poor people who need power will burn coal. What I am suggesting is that we need all forms of electricity. And the form of electricity that seems to give us the most reliable non-carbon generating power is nuclear.
And I could tell you the DC Metro area doesn't know or care the majority of the stuff that you just said. I mean, most of them are acting like Nancy Pelosi. They think they're stock market hedge fund managers now. So that only rational thinking they're doing is they're checking their day trading accounts to see if they can outperform by hundreds of percent. Nancy Pelosi, I think, made $20 million worth of profitable stock market trades in the last 12 months. And there's people in the House of Representatives and Senate that are out earning her with stock market trades on a percentage basis now.
Well, perhaps they can put me in the Senate and she can go trade stocks. That would be a fun trade.
Not sure if you could get elected, Rick, with some of your views right now. A lot of libertarians are not super popular for a lot of the Senate seats, especially because like military industrial complex and the energy spending grift. I mean, like you'd piss off a lot of the major industries.
Jason, were I elected, I would demand an immediate recount.
Well, I think another thing that's beneficial for nuclear power right now, you have a lot of the big tech people. You have Bitcoin entrepreneurs and tech people like at MicroStrategy, Michael Saylor, and then other big tech people like Mark Zuckerberg and Jeff Bezos. They're coming out and saying, look, we're buying hundreds of millions of dollars worth of land in the Northern Virginia area now. We're going to build these data centers, and then we need the politicians and the bureaucrats to approve the power plant. So I think that's how the power plants, especially nuclear, are going to start getting approved in the next 3, 5, 10 years going forward.
I think you're correct. As I say, even the co-founder of Greenpeace has said that the only way that we can accommodate the material needs of humankind without generating as more carbon than we believe is efficacious is through nuclear power. Bill Gates has made fairly substantial investments in technology around small modular reactors. Elon Musk has expressed interest in financing commercial scale nuclear because of the increase in demand that he sees for electricity around the technologies that you're talking about. Meanwhile, separate and apart from these high-profile plutocrats, we are building more nuclear power plants around the world now than we ever have in the past. And importantly, the plants that we're building now are of such a larger scale that they are consuming on an annual basis as much as 4 times the consumption of the median power plant that exists in the world today.
Yeah, I agree that we're going to need to invest, whether it's for just basic electricity needs for the growing global population or for food growth, running businesses, and then also for the data centers. There's going to be a lot more investment needed for copper, for electrification, and then for all the materials needed to upgrade the technologies at the data centers, because it looks like no one's stopping the big technology companies. I mean, they're buying up land in Northern Virginia. I mean, I just see a press release every couple of weeks, and it seems that like Meta, Google, Amazon, and Microsoft are buying up enormous land packages for hundreds of millions of dollars. And that's like a long-term trend. Now in the short term, obviously, like the copper price went up a lot with speculators and hedge fund managers. Long term though, I mean, the copper price is going to have to be higher to promote, and it's going to have to stay there because how long it takes to bring a new mine online.
I think the only challenge the copper price has in the next 5 years would be a synchronized global recession or depression. I'm not saying that's going to occur. Uh, I have had circumstances in my life before where you didn't get the price increases that you hoped in a commodity that was in short supply because the demand fell off as a consequence of a recession or depression. For people who are concerned about the fact that we haven't had a liquidity squeeze or a recession or depression in the last 10 years, 12 years, 15 years, whatever it is, that is something that they need to keep in the back of your mind. You need to temper the automatic bullishness that comes about as a consequence of supply shortfalls and potential demand increases with the near-term possibility of a recession or depression. I'm not an economist, I'm a credit analyst. So I can't tell you if we are going to have this circumstance. But people who are investing in the bullish thesis need to keep in the back of their mind the fact that if you cut demand in the near term fairly substantially with a depression or a recession, even if supplies fall, but prices don't necessarily in the near term have to rise. Looking longer term, that's a very different circumstance. As I say, we have underinvested in productive capacity around almost all of the materials necessary for the life, Jason, that you and I enjoy. This goes all the way up to the top of the feeding chain. In the oil and gas business on a global basis, it's estimated that the industry is underinvesting in sustaining capital to the tune of about $1 billion a day. This underinvestment in sustaining capital, this is a much bigger business, copper business, um, constrains the industry's ability in the intermediate term, say the 3 to 5 year time frame, of continuing to produce oil and gas at the level that the world enjoys today. Never mind at the level that we'll be consuming it 3 to 5 years from now. Again, the big thinkers of the world, the Bidens, the Trudeaus, the Angela Merkels, all those morons, will tell you that peak oil demand will occur in 2030. Um, One wonders how they will fly all their private jets to Davos to tell us not to drive without oil and gas. But you get my point. Across a range of commodities, copper, uranium, oil, gas, potash, across a whole range of the materials necessary to sustain the material standard of living we enjoy. We have underinvested substantially in the last 20 or 30 years. And there's no way in the near term, and I define the near term with regards to that in the next 5 years, that we can address that. There just is no way.
Last question here before I let you go. Are we starting to see in the last couple months, now that we've had this pickup in gold prices, especially copper too, we starting to see a lot of juniors raise 10, 15, $20 million for extensive drill programs, or do you think that we're not there yet?
No, the cash spigot's wide open. The good guys never had trouble raising money. The industry complains it was underfunded, which is ridiculous. In the last 18 months, every private placement I really wanted to get into, I got cut back on. It's not like there wasn't money. There wasn't money available for junk projects. Now there's even money available for junk projects. The financing window in the last 90 days, the spigot is wide open. Anybody who can't raise money in today's market needs to consider going into a different business.
And have you seen any large gold discoveries yet, or copper discoveries yet, similar to the one that Anglo Gold Ashanti seems to have found in Nevada, where there's two fairly large deposits next to each other with the Merlin deposit and Silicon deposit? Is there anything close to that in other countries?
Not that I'm aware of. There's a nice, fairly new discovery, 3-year-old discovery in Guyana, shared, I believe, by G2 and Reunion. I see that at about 5 million ounces and counting. I think it'll go to 10 million ounces. I think what Anglo Gold has in Nevada, admittedly at a much lower grade, uh, probably goes to 12 million ounces. 12 million ounces in a jurisdiction that still permits mining, that's governed by the rule of law, that has the type of infrastructure that the Walker Lane has in Nevada. Very valuable beast. Very, very valuable beast. I do believe that as we are able to explore more challenging terrain, including more challenging political terrain, that we will discover more large-scale gold deposits. We'll discover them in the Archean terrain in West Africa. We'll discover them, I think, particularly in the central part of the Tethlian metallogenic belt. Unfortunately, you have to there explore in places like Afghanistan, Pakistan, Kyrgyzstan, Uzbekistan, Kazakhstan, the stands. Really, really virgin terrain, really, really prospective for copper and gold. So we will discover new high quality, large deposits, particularly if the technology, as I've suggested before, around advanced geophysics and tools like Typhoon. I shouldn't say when, if those things ever come to the fore, I think that you'll see a real renaissance in exploration, but not until then. As you suggest, that Anglo Gold discovery, in terms of what we thought was available in that part of the state of Nevada, is a wonderful surprise and a true freak.
Yeah, I mean, we're going to start to see a lot of drill programs going forward if metals prices stay at these levels or go higher. So I think like we're going to start to see the bull market restart, the juniors. I'm just worried, and I know you've told me a lot of these stories off the record of all the crazy wasteful spending that the senior executives at these junior mining companies did at the conferences, on plane flights, whining and dining people to get them to sign additional private placements. Hopefully that stops. But if there's a lot of capital available, I think unfortunately it's going to be similar to like those Silicon Valley startups that waste a ton of money too.
Jason, it didn't stop during the bad times. If you want to make yourself absolutely sick, pull yourself 25 TSXV companies at random. Look at the balance sheet and the income statement and figure out what percentage of total expenditures went to general and administrative expense. The ugliest study I saw, which was done by us probably 20 years ago, had of 25 companies that were selected at random, mean expenditures of over 65% of capital raised on G&A, meaning that 35% went in the ground. In a typical industry program, as an example, if you and I sold a project to a major and we operated for the major, they would likely allow us 12% in G&A. While among the public juniors, the level of general and administrative non-project expenditures consistently exceeds 40%.
And that's why a lot of the main retail investors listening to this, you should not be gambling on a lot of junior mining stocks. That should not be your gold exposure. First things first, as Rick has said for years, you buy physical gold and silver as like an inflation hedge for wealth preservation and insurance. And then you start looking at safer companies first. If you want to speculate, then you put some speculative capital into juniors. I've seen this many, many times over the last 15 years that some people, they would buy way too many junior mining stock shares and then they'd miss the move up in the gold price.
It's important if you're going to buy the juniors to do the work. Jason, you know that I've graded thousands of portfolios, over 80,000 now. And one of the things I've learned is that most speculators own way too many stocks. I ask speculators to consider limiting their portfolio, the number of junior mining shares in their portfolio, to the number of hours per month that they're prepared to work studying those companies. When I say studying those companies, I don't mean listening to podcasts with Jason Burrick and Rick Rule. I mean reading the 43101s, reading the proxy statements, reading the annual reports. People will send me in laundry lists where they own 60 juniors. And I'm relatively certain that they're not reading quarterly income statements and balance sheets on 60 juniors, let alone reading the proxy statements, let alone reading the pre-feasibility studies or the resource estimates. They just aren't doing the work. The juniors have been extraordinarily good to me, Jason, in the last 50 years. I mean, extraordinarily good to me. but I've worked very, very, very hard. I've been very disciplined, and I've been very lucky. If you're going to compete with me in that space, you're going to have to do the work. Too many people look at the sector, they believe the gold price is going to go up, and the investing technique is, quote, got a hunch, bet a bunch. Doesn't work like that.
Yeah, I've gotten messages where people have just listened to a podcast or they read like one Seeking Alpha article and they went out and put thousands of dollars into a junior, or they listened to a couple different gold and silver podcasts and they bought whatever CEO was interviewed on the Mining Stock podcast. So that it's just shakes my head.
It's insanity.
Well, don't you have the natural resource? You have your conference, the symposium coming up in Florida soon?
Two things I'd like to talk about. Any of your listeners who have an interest in my thoughts about natural resources can personalize it. If you go to my website, ruleinvestmentmedia.com, and you list your natural resource stocks, I'll personally rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments have any value. Separate and apart from that, July 7 through 11, I put on my annual Natural Resource Investors Symposium. You can attend it live in Boca Raton, Florida, or from the comfort and convenience of your own home via live stream. In either case, a couple things you should know. First of all, there will be recordings so that you can utilize the information in the conference for a very long time. You'll need to do that. We're going to give you 60 hours of programming in 4 days, more than you could possibly absorb. The second thing that you need to know is that every public company exhibitor at that conference has been vetted. They have to be in accounts owned and managed by myself to appear at the show. Sadly, there's no guarantee that because I own a stock, it goes up. But there is a guarantee that unlike any other investment conference in the world, every single exhibitor has been vetted. The consequence of that is that if anybody who attends the conference, either physically or via live stream, doesn't believe that we have given them fair value for the fee that we charged, can simply email me, and we have a 100% gold-plated money-back guarantee. The financial risk associated with this conference, the Rule Natural Resources Investment Symposium, the financial risk is all mine.
Very good. And you get lots of big name guests every year. So in the past, you've had Jim Rickards, Grant Williams, Nomi Prinz as guest speakers.
All that, plus big people from the industry. The Living Legends panel, we always have people who've built multi-billion-dollar mining companies from scratch, giving you their lessons as to what you have to learn for. So the Lundin family, Robert Friedland, this year Sean Boyd from Agnico Eagle, Randy Smallwood. We always have people, in addition to the big picture thinkers, who have built multi-billion-dollar natural resource companies from scratch, a very important feature in the conference.
Is Ross Beatty coming down to talk about Greenstone?
Ross will not be coming this year, sadly. This is, I think Ross has appeared at 24 of 28 of my conferences. His neighbor Bob Quarterman will be there. Sean Rosen will be there. Rob McEwen will be there. Randy Smallwood will be there. Of course, Robert Friedland will be there. Sadly, Ross won't come this year.
Well, it's still, no one gets guests like you. I mean, other than maybe like PDAC or whatever up in Toronto, but it's Florida. So I think I'd rather go to Florida than Toronto in the winter.
Well, it's anyway, thank you for that. It's a wonderful conference. And as I say, it's the only conference I know of in the world that has an absolute gold-plated money-back guarantee.
I want to thank you so much for your time, Rick. I always learn a lot in our discussions. I always re-listen to the interviews too. I learned so much.
Well, thank you for the opportunity, Jason. And I, again, encourage your listeners, if they care what I have to say about natural resources, to personalize it. Go to ruleinvestmentmedia.com, list your natural resource stocks. No cost, no obligation. I'll rank them.